The $315 billion blow-up. China takes control of Anbang Insurance Group, the largest takeover of a private company ever. Schooling from Mnuchin. Treasury Secretary says you can have wage inflation without worrying about inflation. Jeff Gundlach says no dice. Inflation snoozer. Japan inflation stays below 1%. Eurozone inflation stuck at 1%. Is FX starting to bite?
Welcome to Bloomberg Daybreak on this Friday, February 23rd. I'm David Weston, right here with Alex Steele.
I feel like it's Operation Get to the End of the Close. That's what I feel like it is today. You had
yeah,
a dramatic couple weeks.
That's tricky.
And now it's just like, get me there and get us off to the weekend. Let's take a look at where we stand. We're just about 2.5 hours till the cash open here in the U.S. Equity futures modestly higher, up by about 0.4%, but it has been all about selling into the close. The dollar is broadly stronger against all G10 currencies. G10 currencies, euro dollar is now up by about 0.2%. Buy treasuries. That has been the theme over the last couple days. Those bond auctions didn't blow up the bond market. Now the 10-year yield at 2.89%. And crude rolling over continued a little bit as the dollar trends higher. David?
Okay, it's time now for the morning brief. This is what's coming up today at 10 o'clock this morning Eastern time. President Trump is going to be speaking at the Conservative Political Action Conference. That takes place just outside Washington in Maryland. And at 10:15 this morning, we're going to get some Fed speak. New York's William Dudley and Boston's Eric Rosengren both appear on a panel together here in New York. And then at 11, the Fed releases its semi-annual monetary policy report to Congress. And at 12:30 this afternoon, President Trump goes back to the White House to meet with Australian Prime Minister Malcolm Turnbull. All coming up today, Alex.
All right, well, now for a Daybreak First Take, where we discuss the top 3 stories of the morning. You know them, at $315 billion China blow-up. And then didn't you know that higher wages may not lead to higher inflation? And finally, where is the inflation in Japan? We thought we'd get to 1%, didn't cut it. David?
Okay, we're going to welcome now Bloomberg's Lisa Brownowitz and our international economics and policy correspondent Mike McKee. We're going to start off with Anbang. I must say, I first heard of it when they bought the Waldorf Astoria or something. What is Anbang? We're going to put up a map now that shows some of their places where they made investments around the world. This thing came, at least for me, from nowhere, Lisa. I mean, and it grew really big, and now the Chinese government is saying, well, maybe not so fast.
Well, this raises so many issues, especially after what we've seen with H&A, which is another conglomerate that is being broken up and forced to sell some of their assets because of liquidity concerns. All of a sudden, Anbang, which has been making those big investments, you could see a nearly $2 billion investment in the Waldorf Astoria and other huge property investments, are they going to have to divest? Who is next? Which other Chinese conglomerate is next to be targeted? What does this mean about international purchases and what that means for the very high end of the real estate market, as well as what does it mean for the Chinese economy if Xi Jinping really is serious about cracking down on leverage and graft?
So, Mike, just to be precise, they're not nationalizing it. They say it's still going to be private. We're just going to run it for a year or so. The Chinese government, right? We're going to charge the former leader with financial crimes, as a practical matter, and we're going to recapitalize this thing.
Well, you have to look at the way they put this whole thing together. And in the last party Congress, they said we're going to try to de-risk a lot of the economy because there was a Wild West aspect to it. Anbang would sell short-term, high-yield products to the public, take that money and invest in lower-yield, long-term products, creating a duration mismatch that raised a lot of risk concerns. They use that money then to go out and buy properties. Now, is Anbang a bad company? Analysts say no. UBS says that this could be a viable company if you strip out all of the high-risk purchases and things. 11% of the company is high risk, and beyond that, you've got some viable businesses.
Well, there is a big question, though. Are these properties going to be worth what Anbang paid?
Well, they're
for
not.
them?
That's the thing.
Well, the Waldorf says no.
Exactly. So if they're not, then that liquidity mismatch, that duration mismatch, is a huge problem. Think about the SIVs during the crisis, or even
with one difference,
yes,
and that is in the United States, we make companies and shareholders pay for these things, or taxpayers have to do it. In China, the taxpayers are going to do it. There's no question the government will just print the money to make this all work out in the long run. They'll put some people in jail. Maybe the founder, Wu Xiaoqi, will have to go to jail. But in general, they feel that they can get through this. They want to avoid an AIG moment, the thing that we saw here, where they had to completely bail out everything. So, all right. Waldorf back on sale. That's the takeaway from this. If you want to buy yourself a hotel, Alex, it's there.
Clearly. I'm the 0.01%, obviously, so I can just go ahead and buy it. All right, here in the U.S., we're taking a look at Mnuchin. It was sort of the story overnight. He said in an interview with Bloomberg, you can have wage inflation and not necessarily have inflation concerns in general. Mike, how valid is this? You're laughing with the supply side agreement.
I'm joining the rest of the economics world in laughing here.
Actually, but an economist who was on Bloomberg television yesterday afternoon said that he thought this was viable.
Probably not, though, because
You're like, no.
For a couple of reasons. One, we're probably going to get inflation anyway. It looks like we're heading in that direction. Finally, inflation is picking up around the world. It's really a question of how fast it accelerates. And the problem for the administration is they're talking about this being a supply side thing. You increase the supply, and therefore you don't have to have inflation. But it's going to take a while to increase productivity, increase on the supply side, and it's not going to take that long for inflation to show up. So how does the market react? The market isn't going to wait around to see if in the long term this works out. And you saw that in Jeff Gundlach's comments yesterday that no, this isn't going to happen. And kind of the universal view of investors, and it's the kind of the obvious thing, is if you get wage inflation like he's talking about without increasing, if you get wages higher without increasing the inflation, then your profits margin is lower, and that's bad for shareholders. But if you get inflation, then yields go up, and you lose on the PE side.
Stephen Mnuchin was echoing what White House economic advisor Hassett had just said. Also, to me, I wonder how much this is a wink, wink, nod, nod to the Federal Reserve, saying, look, you do not have to raise rates so quickly because this is not going to be an inflationary story. It's just going to be a growth story without that inflation, so you don't need to worry about it. That, to me, I mean, because that's been the big tension, right? It's sort of, will the Fed raise rates so quickly that it'll stave off growth in the longer term? I was
just in Minnesota talking with Neil Kashkari, the Minnesota Federal Reserve Bank president. And while this was before Mnuchin's comments, he did say something interesting. He said, we have great disagreements on the board about inflation and how fast we're going to have to act, but we are absolutely united that there will be no political interference and that we will react to inflation.
But more broadly, this is not the first time we've heard this. I mean, this sounds reminiscent of the Reagan years. We heard about supply side
magic asterisk and rosy scenario. You remember,
it's really,
those two lovely ladies.
It's almost a matter of theology or orthodoxy. The people who are really pro-business and pro-growth believe that if you beef up the supply side, it'll take care of itself.
And it hasn't historically, and that's the problem. We have to wait and see if this time, for some reason, it will.
But I like Lisa's point because, hey, there's not an economist now at the head of the Fed. Just pointing that out, too. All right, let's talk about inflation elsewhere. So we got the final read for January inflation for Europe, as well as looking over in Japan. So Japan inflation could not breach that 1%, and Eurozone core inflation to stand pat at 1%. Mike, is this an FX story that we're starting to see for Europe and Japan?
Well, no, not right now. I mean, maybe to a little bit of an extent in Japan, but in Europe, we saw Germany reporting today its GDP numbers, huge export numbers, half a percentage point gain in the fourth quarter. That really powered the German economy, which grew at its fastest rate in 7 years, 2.9% on an annual basis. So the euro not weighing on German trade, and if it's not weighing on German trade, it's probably not affecting the rest of the Eurozone too much at this point. Japan's inflation rise on the headline was basically due to cold weather because fresh fruit and vegetables costs went up. But Japan's in a different place. They've been trying to generate inflation for a long time. They finally got a little bit of it now, and it's just not rising hugely fast. But it's the same story the world over. We're seeing it rise, but not quickly.
But there's a further question about whether the ECB thinks that the FX is a real issue. Mohamed El-Erian is out with a piece right today in the Bloomberg in which he draws a contrast between the Fed on the one hand and the ECB from the account. This is what he has to say in part. Released within 24 hours of each other this week, the minutes of the Federal Reserve and the European Central Bank policy meetings in January highlight common economic optimism, identify similar analytic challenges, but point to different risks. And Lisa, what he says is basically if the Fed said we're worried about a bubble, we're worried about assets, we're worried about financial stability, the ECB really goes after FX. They're very concerned about that stronger euro.
Well, yes, and there's a theory out there, and I think this is very important, that the ECB is driving the bus globally with bond yields, right? And that their worries are, frankly, paramount to everybody's because that's the next shoe to drop with respect to tightening. And if you do see 10-year Treasury yields on their second day of decline, you saw a pretty big decline in German 10-year yields. And there's a big question of whether 10-year yields really can continue to rise in the U.S. if you are seeing softness in some of the data, excluding exports, some of the data in the European Union.
Well, we are seeing strength, though, in Germany, that if it continues, and this is a question that we have
signs of
growth,
overheating.
because it's not just exports, but also capital investment, because they're using up so much slack in Germany that they're starting to spend a lot more, companies are, to try to increase productivity there. If those things keep happening, then they do have an issue of what we also saw, I'm sorry to jump around, but we also saw the first pattern wage negotiations in Germany with a big increase for workers. And if that continues, then you're going to see some inflation there that the ECB will have to react to. They don't think they have to go off course yet, but the markets are going to start thinking about it.
Well, to that point, Jeffries had a note out today basically saying that there is overheating in Germany, full stop, and pointing to the wage negotiation. Guys? Thanks. Lisa doesn't believe us. Thanks so much. Bloomberg, Lisa Ramos, and Michael Rickey. All right, coming up, Mnuchin versus Gunlock. Treasury Secretary Mnuchin says you can have your cake and eat it too. Wage inflation without inflation. Jeff Gunlock says no dice. This is Bloomberg. Mnuchin brushing aside investor worries about rising prices, saying that you can have wage inflation and not necessarily have inflation concerns in general. Jeff Gunlock of Double Line Capital disagrees. On Twitter, he wrote, policies will raise wages without inflation. Yeah, sure. We're going to go expand the Buffalo Art Museum without making it bigger. I didn't even know that Buffalo had an art museum. Vasily Serebrikov, a Credit Agricole FX strategist, and still with us, and with us in London is Lena Komaliva, G+ economist, chief economist. Okay, we were just talking about this on break, Lena, so we're going to start with Vasily first. You say a supply-side argument isn't totally crazy.
Well, I think the point I would make is that, you know, whether wage increases translate into higher inflation depends on the firm's pricing power. And actually, if you listen to some of the FOMC speakers last year, they devoted a bit of time on that. Obviously, the pricing power is still affected by things like global competition, digitalization of the economy, the ability of consumers to make price choices more in a more informed way. So there's a possibility that firms will not be able to pass on the full kind of increase in wages to the consumers of their products. But nevertheless, I think if we take a broader view, you know, over time, higher wages should translate to higher inflation.
So Lena, I'm not an economist, so you have to explain this to me. What has to happen with productivity in order to have 3 or 3+% growth for an extended period of time, which is basically what the White House is projecting, and say, but we're not going to really have underlying inflation? Sorry, Lena, can you hear me?
Yes, hello. Sorry, I didn't hear that the question was towards me.
Yeah,
Hi.
it was.
Hi. Well, I think, look, I mean, there is the fundamental question that you raise here, but if we leave that to one side for a second, there are two very important political and policy implications behind these comments. On the policy front, if a Minister of Finance of any nation is not talking down the trade deficit and talking down the cost of its treasury's borrowing by talking down inflation and talking up productivity, which is what is needed to limit the transmission from unit labor costs towards higher end-user inflation, to the point and the question that you just raised, then this Minister of Finance is not doing his job right. On the political front, however, such attempts to try to politicize the tools of monetary finance by politicizing, for example, the exchange rate or the interest rate, by giving an open-hand sort of suggestion to the Fed that they should perhaps consider the two sides of the story here, and that there's not just a demand cyclical momentum, but there's also a supply-side productivity element which will take longer to see, materialize, and appreciate. I think that's a dangerous path to go towards, because, of course, talking down the U.S. cost of borrowing or the U.S. currency is a matter of international relations, as we saw from the ECB's response yesterday.
So let's put FX aside for just a moment. Apologize to you, Vasily, because that's what you love. But let's just help me as a matter of economics, because what the White House is saying is if we get capital investment up, we will get productivity up, and that will keep inflation down. That's my understanding of their argument. How direct, from an economics point of view, how direct is the relationship between capital investment on the one hand and productivity increases on the other? Lena, that's for you.
Right. Sorry. Yes. Well, the transmission is basically about return on capital, return on on investment. And the truth of the matter is that we have had very positive signals from the stock market that this return on investment is happening. Now, the question is whether this is happening off the back of the productive generation of capacity in the real economy. And here the jury is still out. Now, the importance here is one of time lags. It will take a very long time before the deficit spending and the tax cuts materialize in the form of stronger investment, private sector, public sector, of course, as well. How this is financed and how this is implemented, there's some significant lags there still. And then that, in turn, would eventually improve the real economy eco-structure, the ecosystem that supports productive investment. Now, the dividends are going to be there, but they're going to be there very much in the long term. Whereas for the Fed right now, the inflation calculus is very much about raising questions right now about just how much spare capacity there is, where the potential growth for the economy is here and now in the next 2 years, and how, in turn, that will translate into the cyclical inflation premium that the U.S. economy can generate.
Right.
So the two sides are not inconsistent, but we're talking about two very different time horizons.
Well, fair, but I'm going to propose another theory here. Vasily, is this just sort of Mnuchin's way of trying to get higher yields and a weaker dollar? Because if you take a look at the Bloomberg here, this is HS, the function on the terminal. You can see the correlation between the 10-year yield and the dollar index, almost in negative territory at this point.
Well, yeah, I mean, I think the dollar has been recoupling with yields. I doubt that these particular comments were really directed at the dollar. Look, I think it's obvious that I think, you know, any administration would want an acceleration in underlying growth, right? This is what we want. We know that in the long term, it's all about productivity at the end of the day, the trend pace of growth. And I think there is a currency link here, definitely, in the sense that I think if we were to get an acceleration in the trend growth in the U.S. economy, I think it would be positive for the dollar, because you'd have this kind of a good steepening in the yield curve, in the sense that, you know, the long-term real yields will go up, right, if the trend growth in the economy accelerates. And I think the dollar could benefit, but unfortunately, I mean, in our own forecasts and so far, more generally, we're not expecting that strong of an impact on productivity from this tax reform.
So what are you projecting over the next year as far as the dollar goes? I mean, stay where it is, get weaker, get stronger?
So I think we're in a weakening cycle.
Continuing to weaken.
In a weakening cycle, yeah. It started really last year, and those cycles last typically 5 to 7 years, so we're in that cycle now. It doesn't mean that the dollar is going to weaken every month or every quarter. In fact, the current situation looks a little bit like in 2005, where the dollar actually rallied in the middle of a down cycle. Remember, you also had earnings repatriation back then. So I think if the Fed, if we get a little bit more hawkish in the Fed, yields can go up in the short term. I think as we reprice the Fed, the dollar will be supported. But longer term, well, I think we're still in the bearish cycle.
Okay, Vasily Sorevikov of Credit Agricole and Lina Komileva of G+ Economics. Both of you, please stay with us. And coming up, we're going to talk about the rise and fall of Anbang. The Chinese government takes control of the deal-hungry conglomerate and charges its founder with fraud. More on that next. This is Bloomberg. Big news out of Beijing overnight as Chinese regulators have stepped in and taken over high-flying Anbang Insurance with multiple investments around the world. As you can see from this map, these are some of the places that Anbang has made big investments. We welcome now our Chief Asia Economics Correspondent, Enda Curran from Hong Kong. Enda, thank you so much for staying up so late to be with us. We appreciate it. So tell us how dramatic this was. At least over here, this seemed like quite a big announcement.
It's a very big announcement, David. It's something of a cinematic fall, in fact, is how one analyst described it today. I think there are two sides to it. On the one hand, you have this insurer that ballooned in size through debt-funded acquisitions of trophy assets around the world. And that raised questions about financial stability. It raised questions about how it was being financed. It raised questions of an asset and liability mismatch because they were selling short-term wealth management products, but of course buying longer-term assets. So there was a financial stability side to it. But there's also a very real political economy side to this as well. And it's a real lesson that Xi Jinping is both very serious about taking risk out of the financial system, and very serious that the iron fist of state still rules over everything in China's economy, and that if you are a private enterprise and you do want to go on overseas adventures, you really have to fulfill the national interest and meet the Communist Party's objectives.
All of which he signaled in the 19th Party Congress. He said all those things, he was going to do them, and now it appears he is doing them. What reaction are we seeing in the markets over in Asia to this action?
Look, the market reaction has been relatively controlled because, as you say, there has been an expectation or an understanding that China is clamping down on these conglomerates. But nonetheless, the severity of the move today, I think, caught a lot of people by surprise. One analyst said to me it was like the Fed and FINRA and SEC taking over a company. This is not a takeover by any conventional sense that we would understand it in the West. It's very much the state going in, and while they say it's a temporary takeover for 1 year, there's also an opening there that there's no guarantee that they will take a year before they run down the assets of this company and get the financing involved. They've left it open. They could stay in control for more than 1 year. So it's certainly unprecedented in its size and manner, both in China, and certainly very unprecedented by what we'd be used to by Western standards.
So, and what does it wind up meaning if you're a company right now? If you come inside the Bloomberg here, you can take a look at China's breakdown of debt. This goes back to the end of 2016, and the white bars are corporate debt. So clearly, it's the corporate sector that is uber leveraged. If you're a company, are you saying, cool, I'll just keep doing that because the government's going to bail me out?
Yeah, well, look, certainly raises the question of moral hazard. There's no doubt about it. But at the same time, though, there is a feeling that there is an element of near-term pain here, that the authorities are clamping down on those companies who've borrowed in a big way. They do want to slow the pace of credit growth, which will mean in the near-term economic pain and disruption, such as like what we're seeing in the conglomerate sector. But longer-term, this is all about putting the economy on a more sustainable, durable footing and moving away from the kind of debt-funded growth that we saw during the go-go years. So, yes, it raises questions of moral hazard, but I think the bigger picture here is that it's part of a shift that many analysts say China needs to make.
Enda, thank you so much for staying with us. We really appreciate it. Enda Curran, Bloomberg's chief Asia economics correspondent. And coming up, inflation challenges. We're going to look at challenges faced by Japan and Europe. This is Bloomberg. This is Bloomberg Daybreak. I'm Alex Steele. Operation Get to the Close without a lot of drama. S&P futures up by about 11 points. We have seen selling into the close the last few days. Will that continue? European stocks on the upside there, despite the fact that core inflation did not go anywhere in that final read, still coming in at 1%. The FTSE a little bit weaker as the Brexit drama continues to roll out, and the European leaders basically turned down a potential deal without even hearing the specifics, plan or no plan. In other asset classes, take a look at what's happening with sterling. It's a broader, stronger dollar story, with the exception of what's happening with the cable rate, almost hitting 140, up by 0.3%. In the 10-year, you're looking at on a weekly basis, the 10-year yields are on their longest streak of gains in almost 24 years. However, you have JP Morgan saying we could see a short squeeze coming in the bond market. We have seen some solid buying over the last couple days, and crude a little softer as well. David?
And now let's get an update on some headlines from outside the business world. Taylor Riggs, she's here with First Word News. Good morning, Taylor.
David, in Florida, authorities say the only armed sheriff's deputy at the school where 17 people were killed took cover when the shooting started instead of going after the attacker. The deputy has resigned after being suspended, and the sheriff says his office received about 24 calls about the suspect over a decade, but may not have followed up adequately. There's a report that the Trump administration is considering an offer from billionaire Sheldon Adelson to pay for a part of the new U.S. Embassy in Jerusalem. The Associated Press says government lawyers are looking into whether it's legal to accept the money. That would add more controversy to President Trump's decision to move the embassy from Tel Aviv. In Australia, Deputy Prime Minister Barnaby Joyce has quit over a sex scandal. Joyce has been having an extramarital affair with his former media advisor that led to allegations he breached ministerial guidelines. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Taylor Riggs. This is Bloomberg. Alex?
Thank you so much, Taylor. Well, the inflation story. In Japan, it stays below 1%, while Eurozone inflation still stuck at that 1% level. With us to dissect the data and what it means for markets is Lena Komoyeva, G+ Economics chief economist, and Vasily Serebrikov, Credit Agricole chief FX strategist. Lena, the potential story this year was that a combined convergence of central bank tapering. Is it now continuing to be a story of divergence?
Well, I think it is important to recognize that the story in global bond markets is greater than the month-to-month changes in the CPI figures. We've seen nothing short of a regime change in 2018 compared to 2017. If in the last 12 months there were concerns about a mediocre kind of pace of growth of 2.5% in the US, today the realization is one of a very coherent global growth environment. If in the last year there were fears and questions about whether the unemployment rate is low enough to predicate more rate hikes from the Fed because of concerns about weak wages growth, today there is a solid confidence consensus out there among policy officials and investors that at the very least the era of low inflation is over. But I think the important thing here is that we don't really need strong inflation figures here at this point to justify higher bond yields. In fact, if you look at US labor costs, if you look at US wages, not much has changed in the last 6 to 8 months, and yet US 10-year yields are 90 basis points higher than they were in August 2017. Again, the same story in the euro area. And in Asia, the subdued inflation in the Eurozone has not stopped the ECB from moving towards ending quantitative easing, which brings forward, in turn, the end of negative interest rates, a historical transition in policy in place here. And so I think that coming from this point, I think the risks to bond yields are clearly asymmetric. The Fed will not, in fact, need stronger inflation figures to deliver at least 3 rate hikes this year. The ECB does not necessarily need inflation to push towards the below but close to 2% target within the 12-month horizon in order to end quantitative easing.
Yeah.
And with that historical support for low yields and low volatility for the markets is coming to an end.
So, Vasily, putting aside from what the reaction of the ECB or the Fed, or for that matter, Bank of Japan is, what about the data that they're confronting? Are the data they're confronting different? I mean, are we seeing real inflation in the United States as opposed to Europe, as opposed to Japan?
No, I think you have a global cyclical upswing. You have different economies at a slightly different point in the cycle, obviously. There's still quite a lot of spare capacity in Europe. So inflation is going to pick up quite slowly, in our view. So we don't actually think we're going to get to 1.3, 1.4% core inflation until 2019, which is when the ECB is going to start hiking rates. Obviously, every central bank has to make policy for inflation 1 year down the road, not inflation today. But we sense from the ECB that the war on sort of deflation hasn't been completely won, so they've been pretty careful in their communications. And I think the same in Japan. I mean, we have seen some positive news on the inflation front, but we actually don't think that core inflation, so once you strip out both energy and fresh food, is going to get consistently to that 1% level until 2019. So, the question is, yes, we know they're going to be all tightening policy, but how quickly is it going to happen?
Right, but then we have dollar yen at 106.
Right. So here it comes, and the ECB is dealing with the same issue as well, right? I mean, the euro has strengthened. You could make the argument that if you look at the trade-weighted euro, it hasn't strengthened as much as the euro-dollar, so maybe it's not as negative. But that's what they're going to need to manage. I mean, the currencies will need to be managed, and maybe that's one of the reasons to not expect a kind of extreme dollar weakness from here, because so many of the other central banks are not very comfortable with a lot of strength in their currency.
So let's turn from this to what this means for investors as they look at all this, whether it's FX or whether it's central bank policy. What does it mean for investors? Here's what some people have had to say about Europe as an investment.
There are long-term opportunities, and we can take advantage of this. On top of this, the economic activity is good in Europe. We have growth rates that we've not seen for the last maybe 10 years. Across the Eurozone.
For the last 2-3 years, we've been reducing the U.S., increasing Europe, increasing emerging markets. In Europe, we own some materials companies like Symrise or Novozymes, Atlas Copco, some of the industrial gas companies that are actually very international. They just happen to be headquartered in Europe, and we find them at cheaper valuations than in the U.S.
Where are you most excited about your business and your portfolio?
Well, actually very excited about Europe, doing very well, rebounding very nicely on a continent in front.
There's been a tremendous amount of good economic news out of the Eurozone. That's no secret. After the last 12 months, they've had some of the biggest, on a relative basis and even on an absolute basis, they've probably put in more growth than any other major economy.
So, Lena, what about it? We just heard from a series of CEOs and investors and analysts. They're all basically saying, boy, it's time to buy Europe, at least when it comes to equities. Does that make sense to you from an economics point of view? That's Lena.
Hi. Yes, I think, well, look, I think that looking at the tea leaves of month-to-month changes in inflation or international comparisons has been a very poor guide to exchange rate development. So you just have to look at the spread between euro-dollar and Euribor over the last 12 months to realize that it's got nothing to do, really, with the exchange rate movement of the DNA of global finance, which is the dollar against the euro. Now, I think what makes sense, however, is understanding interest rate movements, exchange rate movements in the context of the global risk cycle. In the last 12 months, we're still seeing the early stages of an unpricing of the dollar's strength that occurred between 2014 and beginning of 2017, which happened in a very different international risk environment of concerns of taper tantrum, concerns about a hard landing in China, questions about the strength and durability of the Eurozone recovery, and a deflationary oil price cycle. Compare this with today's environment of coherent global growth, of confident policy backdrop, of a reflationary commodities price complex, and it is a very different story. So I think that in a world where central banks are prioritizing growth over inflation control, it's too early to expect a normalization in exchange rate versus interest rate relationships.
Right. But on the flip side, Vasily, you talk a lot about investment coming back into Europe. Just this last week, we saw outflows of $2.4 billion in the U.S. and inflows of $3 billion into Europe. What does that wind up doing as cash continues to come into the Eurozone?
Well, that's partly the reason why you're seeing the euro outperforming interest rate differential, right? So there's been clearly a big asset reallocation story that has favored the euro. I think the story is going to continue. I mean, you showed a lot of opinions. There seems to be strong consensus behind European growth, but I don't think consensus is wrong. It looks like there's scope for European equity markets to continue attracting inflows, and that's why we think the euro will be supported. In the foreign exchange markets, I think investors can also get a little bit more creative with how they want to play the European recovery. So let's not forget, there's not just the Eurozone. There's there's the Central European economies that are highly geared to the euro. There's countries outside of the euro currency area, such as Sweden and Norway, that are also highly geared to that recovery. So there are opportunities kind of not just within the Eurozone, but around it as well.
But Vasily, at what point does a stronger euro start to interfere with the underlying economy? I mean, that's something Mohammed Al-Arian has a piece out today in the Bloomberg in which he says the ECB, if you look at the account, they're concerned about FX, because if the engine of growth is in part exports, and particularly German exports, that stronger Europe can cut into exports at some point.
It is true. This particular recovery has been more domestically driven than most of the other recent recoveries, and I think that's an important point. I do think that they are more concerned about the euro. We've heard about this from the ECB officials. As mentioned before, part of it is dollar weakness, so there's not much the ECB can do about that. And the trade-weighted euro has not been necessarily as strong as the euro dollar. I think if they're in this 120, 125 range, things are okay. If we had a quick run towards 130, and let's not forget, fair value is probably around 120, 126 in our view. And PPP is just under 130. So if you cross over 130 quite quickly, I think that really is a much stronger argument that it's becoming too expensive.
Walk me through the next 8 or 9 days when we go into the Italian election and we wind up going into potential coalition with Germany. What's the downside potential?
Well, I think, we haven't priced a lot of election risk, and I think ultimately the outcome we think is going to be quite benign. Nevertheless, experience tells us that going into those elections, markets like to hedge their bets. So we're probably going to see a bit more increase in kind of euro downside risk going into the Italian elections. We think it's going to bounce after that. And really for us, the focus now is going to be a bit more about the Fed and the reaction function here.
Okay, Vasily Serebryakov, Credit Agricole FX Strategy, and Lena Komileva of G+ Economics. Thank you both.